Alrighty, Jack, my man, long time no see. A
I was listening to that song. I'm gonna have to play that after we get done. That was great.
little bit of Pearl Jam.
Earl, thoughts on here. You got to know I love you too, Earl. Killing it, man. Love to see the success that you're having. For folks that don't know Earl, he is just a monster in this market, making so much money. Earlier this morning, we all sold a bunch of covered calls together on NVIDIA, GOOG, and IBIT, and that was great. So how you doing this morning, Jeffrey?
Well, Dollar Tree reported earnings today.
Oh
Look at
yeah.
that.
Let's
Look at that.
see. Bring it up.
I got it up right here on the screen
That's
share. Should it be? Sitting at 102. I sold the $100 strike we talked about yesterday on the profit panel.
yeah. So now, when did you sell that naked put?
I sold it on Friday, got paid almost 80 cents per contract for it.
Dang, that's
I think it
that's
was over 80 actually. Price on
that's all.
Friday was up here, and I got down all the way down here to 100.
Oh, gap
Earnings
gap down on the earnings, huh?
gap down on earnings actually touched below my strike, but I'm out to Friday. Things are recovering. They actually on earnings, when the actual earnings came out, they were they just like blew it away. But their guidance on the call was a little bit negative. And look at that, beat by 84 cents on the or 84% surprise on how much they did make, but their forward
That,
guidance was a little weak, so dropped down a bit. But that's what I
that's
expected.
that's the thing, the earnings can come out and it'll be better or worse than expected, and that'll cause a reaction in the stock. But the real reaction comes not from what they report, but from what they say after the call, after it's all out, right? So if they give any kind of good earnings, good guidance or bad guidance, that's going to be the case. And the most dramatic example of this I've seen was with Caterpillar. Caterpillar, a one time way back, reported better than expected earnings, and uh, they had it. And then the guys went on to talk about we had the largest back order we've ever had in the history of Caterpillar. And that was seen as good news. And then he goes on to say, but the backlog isn't as big as it used to be. And the stock just in seconds, right? And that's after beating earnings estimates. So that's why I say, folks, the earnings are one thing, but the guidance, what comes out of their mouth is a whole nother cat.
The whole point though, I sold these way down here with plenty of room. Yeah, we were doing the math yesterday on profit panel, like a 92% annualized rate of return roughly for that position. Just crazy numbers.
It
And
is.
that was if you had sold it yesterday. And this is the kind of stuff I love to do, Jack. I know you love it too.
Love it too. This one though, you're going to see that gap is going to get filled in. I mean, billion-dollar companies don't drop 8%, right? That's usually an overreaction, right? Be less
Yep.
sellers and that thing drift higher. So now, did you want to get assigned or you didn't
I
care?
I never I mean, I picked the price that I would love to get put at. I wasn't trying to be overly aggressive. I think one of the questions on yesterday was why didn't I go closer to the money? Because I would be instantly upside down if it, did drop, and it did drop. But right here, if I got put at 100, that's a great place. Like that's my technical pattern. That was, support I thought was for my technical pattern. And I wouldn't have to sit upside down if it did drop, which it did. So, I mean, I tend to go at support when I sell my puts because if I get put and things go sideways, I don't want to be as upside down as if I'd gone up here at like a 110 or something like that. I might
Mhm.
be sweating it a little bit down eight bucks, 8% down. But right now I'm still out of the money. It did dip in the money a little bit, which is what I kind of thought could happen if this rocks and rolls along till Friday, I might still get put shares, possibly. But right now, it's looking like it's probably going to go higher, and I just collect all that money.
We had a lot of questions about naked puts. I had a cash generation class earlier today, and a lot of the questions about the naked put is how do you pick the strike? And people use different ways to do it, but you give them a little bit of an overview of how you pick the strike to do a naked put on a stock.
It takes a little bit of math. There's tools you can look at to do this, but I like to go for something around a 40% annualized ROI is what I call it. That's return on investment. And I don't use any kind of margin when I'm doing this calculation. I look at the full cost of the shares. Last Friday, for the money I got in, this thing was like a 42, I think it was sitting at right at 42% annualized ROI when I get in last Friday at the 100 strike, getting paid. I'll pull up the exact trade. I posted it
So
in
you're
my.
looking at a percentage ROI to pick the strike price, not a level of support.
It's two things coming together. So I want that ROI. First, I look at the ROI, then I look at where that ROI comes in, because not all the strike prices are going to have the same ROI. Like the 110 had something like 150% ROI, or maybe even 1,000% ROI, but that 100 strike had about a 42% ROI. And that's take the dollar, the days you're in the trade and the percent, you take, like, I got 80, let's just call it 82 cents. And that equated to $82 profit for a $10,000. If I got put the shares, it was going to take 10,000 bucks per contract. I was going to make 82 bucks, and that was going to be for 7 days. So divide 82 by 10,000, then divide that by 7 days. That gets you the per day return. Multiply all of that by 365. And I like to get around 40% when I annualize it out. And some people are like, well, you're only in the trade for 7 days, not 365, or you can only trade for 320, 300-ish days a year, not 365. But if you were to buy a contract out for a year, it's the same deal. Like I want to get about a 40% ROI. Now, once I find the strike that matches that, I bring it over here and look at where it is on the chart. If it gets me right near my support, that's like check plus. I was like, good to go. I like it. But it has to be, the stock also has to be already bullish. Or at
Yes.
least have some bullish things working for it. Like it already made support, proved its support, made a move up, made a retrace, held a higher low, and we're set to go higher. I have I have a few technical patterns that I look at. This particular one right here, I call my roadmap bounce. We'll talk more about that later on today, Jack. But right there, that roadmap line, that's support. We hold that, price tends to bounce. And I mean, that's the exact same thing I did on the Rocket Lab trade that we have broken down a little bit. So I looked for a move down, a bounce, and a move up, and got it and went after it.
It's fascinating that you do this on, you know, I'll just say it, boring stocks. You did it on the Gap, you did it on Urban Outfitters, and you did it on Dollar Tree. And you're making money really without buying any stock. I mean, imagine
Yeah.
making 40% a year, folks, without buying a stock. Never, right? How about that? That's a very beautiful way to go about making money in the market. Plus, you're getting paid every time you sell a naked put. Remember, you're getting paid instantly. So here's how you make a ton of money without ever buying a stock. And it's a whole new way for a lot of people to trade, a whole new world.
Yeah, whole new world. Funny enough, uh, I don't know if I ever told you the story on I I started real money trading on the back of the or right before the dot-com bust blew apart. Late 90s. Just got out of high school, opened me up in a brokerage account. I had three different uncles. Yeah, have I told you the story, Jack? Um,
No, go ahead.
yeah, I had three different uncles that worked in different capacities in the stock market. game. One of them worked for a mutual fund, and he created baskets of stocks and went around to other mutual funds and tried to sell those baskets of stocks. And he would get, like something like 1/100th of a penny commission for every share that he sold in the basket. And he would turn over, hundreds of thousands of shares every month to sell in other funds. And then a second one actually managed a Edward Jones office down in L.A., Lower Alabama. And then a third uncle I guess he still works for, I think, Deloitte Little, doing accounting for public companies. And they all make really good money doing that stuff, or they did. I think one of them's out of the game now. Maybe another one might be out of the game. But I called the one that ran the Edward Jones office in Alabama, and I was like, "Hey, what's the best way I can learn how to do this? I have a brand new brokerage account, all this stuff." And he was like, "All right, first thing you do, call up E-Trade, close out your brokerage account." He's like, "People like you cannot make money in the stock market. Like, this game is just rigged against you. It's not for you. It's not, it's not the way you're gonna do it." I was like, the gauntlet has been thrown. Like, I got to figure this out.
Well, it's interesting you say that because Edward Jones, folks, is a regular brokerage firm, right? They brokers do not believe you can do it. That's just the way it is. They think that they got their Series 7 license and now they're the only ones that can do it, that they know more than you and you can't possibly learn as much as them. But I'm glad you took that as a gauntlet,
Yeah, I mean,
as a challenge.
it was a personal challenge for me to crack this baby. It did take a lot longer than I figured. I know I'm a pretty smart guy. I pick up skills very quickly. I figured this couldn't be that difficult to figure out. And for a long time, I figured I just needed to know more stuff about the market. And it turned out I just needed to know one really high probability thing and exploit that one thing. And that's my technical pattern right here. But on the back of the .com bust, I hadn't learned all this stuff, and I was just still a stock picker, and I'm probably one of the luckiest stock pickers that I've ever run across. I mean, I've just gotten absolutely lucky picking stocks. I picked up Red Hat at $3 a share, and Red Hat was a Linux company that went public during the .com hype and went rode this baby down. They were at like $120 a share during the peak of the .com stuff, down to $3 a share.
Wow.
I bought it at $3 a share, and for 18 years I held that stock. I sold calls along the way. Learned how to do covered calls, learned how to do, selling puts and stuff like that. When IBM bought out Red Hat, they paid me $190 a share for that stock I paid $3 for. And on top of that, I had sold calls along the way, and my little $500 account where I bought 100 shares was worth $26,000. And that's the only trade I ever did in that account when IBM bought it out.
I love it.
So
Well, there's
that's the power of this thing.
a lot of perseverance. A lot of people wouldn't have the patience to stick with it. But once the gauntlet has been thrown down and you take the challenge, then it's game on. I'll remember the day I got fired from Dean Witter. I was there for exactly 1 year, and I got fired for failing to produce enough commissions. We were just glorified telemarketers, right? Making cold calls, 300 cold calls. And I was interested in trading at the same time. I was getting fired. I busted my own account. I think I told you that on
Yeah.
I had a call. And I'll never forget this guy. His name was Mitch Miller. And man, I never liked this guy, even from the very beginning. I liked the assistant manager, but this guy hired me. I didn't like him. I don't think he liked me. We were just two different people. And I'm sitting at his office, and he just like, "Come on in. Today you're getting fired. Here's your pink slip." He finally sits down. He says, "Don't do anything in finance. Don't do it. Don't even do it for yourself." And I was like, "Okay, it's game on right now. I'm getting fired and I'm broke, blew up my account, but this ain't gonna stop me. You know, you got to be persistent. You got to be determined. And I took that as a challenge too. And it gave me a lot of motivation. I wanted to prove that son of a bitch wrong. And in the end, I did. So got that going for me. Now, one quick thing came up here before we move on. Jim says, Jeffrey, when you're making these naked puts, you're making an assumption you don't get assigned. If you get assigned, you have to buy the stock, don't you? And
Absolutely.
but you're not making the assumption that you won't get assigned. You're
No.
that's the beginning of the wheel, Jim.
So
So
yesterday, this particular trade was going for 75 cents while we were on profit panel. You know, if you want to go check out the replay, that was with 3 days left. So that's 25 bucks a day right there. When you annualize that out, 25 bucks. And we were taking the full price, 10,000 bucks. That's 10,000 bucks it's using to do this, to buy 100 shares. So it's not like assigned, not assigned. It's 10,000 bucks per 100 shares. 25 bucks a day. That equates out, when you multiply it out by 365, that was 92.5% rounded off, annualized right there. If you had done it yesterday, you know, I had done it a week out and had a 40%, but this was actually a 92% yesterday, right before earnings. 100 strike. You know, yesterday we were hanging out up here at 110. That was $10 of downside protection. That ROI doesn't change. It's not assuming anything. That's return on the money right there.
without buying a stock, folks. Who, you know, people say, hey, look at that. That's a whole different way to do it. You're not buying stock, you're just selling naked puts. Now, Jim says you're making the assignment. If you get assigned, you have to buy the stock, don't you? Yes, you do. So if you get assigned, what's step number 2? So step number 1 in the wheel, Jim, is, and folks, selling a naked put on a stock trending higher when you wouldn't want to buy mind owning. So you sell the naked put, then you either get assigned or you don't get assigned. You don't get assigned, you do it again. But what do you do if you do get assigned and you do take the stock, Jeffrey? What's the next move?
All right, so you got two options basically. One, if by some chance of the market, the day after you get assigned, price is trading at or above the strike price you got assigned, or above your cost basis, because it's not just the 100 strike, it's 100 strike minus the credit you took in is your actual cost. So it's, 75 cents, yesterday that it was trading at, your cost would actually be 99.25 a share if you had gotten that 75 cents yesterday that we were showing. So if price was anywhere above 99.25 after you got put, you could just sell it right there and you come out. Like, you give up some of your profit. Anything under 100, if it's above 100, you get to keep the profit of what you sold, plus any above 100 it is. So you could just sell the shares. Second option, that's just option 1. Option 2, potentially you could do nothing and just wait. Option 3, you come down here, open up the option chain, you look out in the future, and you say, all right, for next week, I can come over to the call side. I can agree to sell these shares for 110 and get paid 42 cents. Or I can sell them for 109 and get paid 56 cents. 56 bucks, basically, 56 cents a share. You could come down right at the money. Get paid almost $2 for 1 week. You can fly out further. Now, I'm particularly interested in the week because when I look over here, 1 week out, the implied volatility is 40%. It's the highest it is on the entire chart. Even going out 1 year, 1 week out is higher volatility. And this little chart, not many people understand necessarily. I don't know, Jack, do you even pay attention to this? But I like it because
A little bit.
it tells me where the best bang for the buck is. And right now, that's 1 week out.
Yeah, and that's interesting because most of the time you would think that you'd get a better bang for your buck further out in time because you're either buying or selling more time value. But that IV structure is really important because it's just showing you're getting paid more for the week out than you would for the month out. That's a great tool.
I love that they added it on here recently. it wasn't always on TradingView, but now it is. And you can look at the IV term structure and see where the best bang for the buck is. I used to use uh, long ago when I learned options, it was Trade Monster is where I picked up the platform, and then it got bought out or converted into Option House, and then E-Trade picked it up, and now it's part of the Power E-Trade system. But that was for a lot of years, that was the only place I knew of you could look at the IV constellation was in that platform. Now TradingView has it right here included, and I can just look at it and see, see what I need to see without going anywhere else. I love it.
That's awesome. That's really cool. How about
So
that
what you would do?
October 17th?
Yeah, I mean, you could go out further, and but right there, you could go out a week and collect nice premium. So we could fly on out October 17th. You
Doing it
could
weekly. Awesome.
you can fly up. Look, it's incredibly, it's not that much more money. 115, you get paid 120, $1.22 right there. That's not all that much more though. $1.22 a share for going
You're
that
better
far
off
out in
doing it
time.
weekly. Better off doing it weekly.
Yeah, way better off. And not every stock is that way. People are like, well, what do I do every time? There's not a every time. This is every time you got to come check it out. Where's the best bang for the buck? Where's the opportunity? And it varies by stock. It varies by time. It varies by lots of different little components into this. Everyone's a little bit different. Varies by sector. Hot tech stocks have a whole different IV term structure. And we can one of Jack and I's favorite, big dog Tesla here. See the term structure completely different here. You're actually better off playing a month out.
Yeah, or 3 months.
Or even 3 months where it kind of levels off out here. So everyone's different. They have different traders involved, different algorithms running in the background, different market makers, different pricing algorithms running, and these things get priced differently. How do you? It's very simple. Where's the highest point on this chart? Right here. You're getting paid the best bang for staying in the stock out a year on this one. All right. But then again, you have to weigh you're going to tie up your money for a year. I kind of weigh it, how long do I want to be tied up versus how much do I get paid?
Yeah.
And, if you want to get the best bang for the buck on Tesla, that's out a year. If you want to, like on Dollar Tree, where we were just a minute ago, the best bang for the buck, if you're going to sell options or sell credit, 1 week out right now. And this can change next week. Like it could be a whole different thing depending on what happens.
You might get a better bang for your buck on a year out, but you're more efficient when you're doing it weekly or monthly, right? You're just turning it over more. So I like the weekly too. Dennis says he likes the weekly. I like weeklies. Just on covered calls, I like the monthlies, just to keep it simple.
And see, I was playing 1 week out on Gap because it has a spike here. Otherwise, I'd have to play like 3 months out. And I've been cranking out the 1 weeks and 1 weeks and 1 weeks because I didn't want to have a long-term exposure to, the thing is your theory may come true before the time hits. And if your theory comes true before the time hits, then you're still sitting on all that implied volatility and you don't get to cash out on it when you're ready to be done with the trade. So it's a time balancing act too. So I like to play a little shorter in duration. It doesn't tie up your money nearly as long.
Yeah. Jim C's talking about the interesting thing. I understand everything you guys are saying. The only problem is the unlikely situation that you picked a stock that continues to go down week after week. Your cost basis continues to go down, but you picked the wrong one to execute on. Yeah. Well, you get out, right?
And you get out, you accept your lumps, you took the risk, or
everybody knows, and you move on.
I am in one, Jack. Like I'm in this one. I got put. We can look at where I got put in the trades. This is all on my public record. I'm actually in this stock. Let's see. Last time I sold CMG was right here. I got put right here. I got paid 38 cents. I got caught. I was at 49 strike back on July 25th. I'm still in it. I still have 400 shares. I got put right there on the 25th. Let's just take a look at where I am, what it is, and
what are you going to do?
What am I going to do? So here's I've got an alert sitting at the place where I was put. We gapped down back here, July 25th. You see what happened? Earnings went further than I thought it would. I was actually at a support. I thought this was support coming across here. Sold that 49 just above it. I thought we'd hold support. Guess what? Didn't happen. I'm sitting right here at a 49.
Now, are you going to sell calls? What are you going to do?
So right now, there hasn't been much premium available. You know, this is back to, we talk about that beta, and the beta is a little bit under $1, under 1. So it's a little less volatile than the S&P. There's not a whole lot of premium up here at 49. I used the wrong, I was going to put an arrow here. There's not a whole lot of premium up here right now. So my plan, I don't plan on just selling this for loss. I just don't. This actually was another support level down that I thought we might go to. That's why I put a big circle there. And another one down is right down here. And I have 2 alerts sitting here. Right there. This is this is my personal plan. This is not like necessarily the way you do the wheel or the way anybody. This is my emergency kit plan for fixing one of these. I don't plan on booking a loss unless Chipotle just really starts falling apart. I think it's a good company. I think we're in a correction, and eventually it's going to work its way out of this funk and return to an uptrend, potentially go much higher, up to 100 potentially. But right now, they got some stuff to work through, and they may go down further. When we get down in this vicinity right here, I'm going to sell another put around 33 or 34 and potentially double up my position. That's 30% down from where I got put initially. And that's the first time I'm going to do anything on the downside. Now, you could buy a put, you could do whatever. You could argue that I'm not doing this the right way. It's okay. This is my plan. I had this all written out, worked out with alerts on the chart before I ever sold that put at 49. I have a exit plan, a rescue plan every time I do this. And we haven't really talked about rescue plans, but this is my rescue plan. Jack may have a different idea on how to do it. I don't plan on
It depends on what's going on with the stock.
Yeah.
That's what dictates the move, right?
Yeah. And you see, I look back over here, and this area where I have my 30% down is another area where the stock hung out for a long time. Right there. So I'll probably sell more puts when I get down where I can get premium for those puts at that price. Start reducing my cost basis on these. And if I get put, it reduces the whole cost basis, average down with a 30%. And then the likelihood we bounce back up to a profitable place much higher, because that brought my cost basis down.
Yep. That's a double benefit, folks. When you're selling premium, you're doing covered calls, you're lowering your cost basis every time you bring in premium. And if you're doing naked puts, same thing. So let me show them something. Bring up IBIT. Here's what I got a naked put, and I got assigned. So I put the 65 strike price naked put that expired last Friday. And the stock went below 65 several times. I never got it right until Friday's expiration. I got it put to me at 65. And right now it's lower than that. But this morning I sold the 70 strike price call. So, yeah.
So he's at this blue line right here. If we find ourselves up here, how far out did you go?
October 17th.
So we went out to October 17th over here. If from now till here, we find ourselves up here, Jack makes $5 a share plus
The
The
premium
credit
on
he took in,
selling the naked put.
plus the premium there, plus the premium here. He made money. He'll make money here, getting put, here on the stock appreciation, and here
Getting
committing
called
to
out.
sell it, getting called out. Now, if it ends up down here, he still collected this and he collected this, and he lowered his cost basis, and we just do more.
Keep rolling it. Yep.
If it ends up in here, he keeps this, and he can sell another one even farther up.
Now I'm looking at selling. Look at the options on this thing. Like, if I sold a 63 naked put today, I've sold covered calls, but if I do another naked put,
Would you do it for this week, or would you do it for next week?
I do it for next week or even further out, the 17th again.
Let's look at the volatility structure. You see it. The longer you go, the higher it gets.
Yeah, but I want to turn the money over, so I'm only going out a month. But it's about $3.
Let's see, 63 right here. Yeah, 280 right now.
Yeah, it was 3 earlier. So that's a lot. I mean, if you do the math on that.
Yeah, we could do some math. Let's just assume 280. 280 right there. We've got how many days is that? 40 days?
44.
44. All right. Yeah, I think it was 45 yesterday when we were talking. So pop up the handy dandy calculator. I don't profess to be able to do this in my head. So 280. This is 6,300 bucks. So we divide by 6,300. That gets us 4.4% return just in the time frame. That's 44 days. Return per day, 0.1%. That's 0.1% per day for 44 days. Right there. And yes, it assumes, we're kind of assuming that IBIT may be at or above, but this is the return on this right here. Even if you got put these shares, the return on this put is that right there, because you get to keep all that credit, even if you get put. All right. That's what a lot of people don't really like. They don't think about it this way, but the return on that put is 0.1% per day. Now, annualized out, 365 days, it's 36.86%. That's right in line with my 40%, plus or minus just a little bit. That's right in line near a 40% ROI. It's actually 36.8%. So, Jack, you're right in the same ballpark that I shoot for. Yep. Right there.
Yes, sir.
Right there. So you and I, we may come at it different ways, but we're targeting kind of the same, the same thing right there. Now, funny enough, you got put. I got put several weeks ago up at the 64.50. I had sold. We just come on here and look at it. What I actually got. Let's see. IBIT put option right here. I sold 4. 3 of them went out for $0. One of them assigned me. Right
Isn't
there.
That crazy? You would think you'd get the whole enchilada. If you put out 4, you'd get 4, right?
Yeah, but I collected the 240 bucks profit right there on the full position. But I got lucky and got to own 100 shares at 64.50 a piece. So I only have one. I don't have my full position of 4. So you know what I did on that drop Friday? We were down, you got assigned. What I did, I came in here and sold a 59 for this Friday.
Nice.
When we were down here, I got paid for selling the 59. I just did one because I want to double my position and lower my cost. I'm just going to build my position at this point. So I sold the 59 and it's almost full profit now because, price is moving higher again.
What kind of position would you build in this? How many shares would you?
4 for me right now. That represents roughly, I'm looking to hold about 6 positions in this account. So I take my account balance, divide by 6. That leaves me right around 18 to $19,000 per position. And
You know,
4 would
how
be a
many,
little rich, but I'm going to be right in that ballpark,
how many
right
shares
around
do you
12.
have?
So it depends on the price, of course, but at a price around $60, that's 400 shares. That'd be a $24,000 position. So that's
Yeah.
that's probably my
What do you
full
think?
size.
3,300 shares is too much?
Well, it depends on your account size and how many positions you're managing. I mean, not everybody's the same, right? You've been doing this a lot longer than me. You may have more money in that particular account you're doing, and you probably do. My little account right here I keep showing off is only about $115,000. So
That's good.
I don't have huge working capital. I'm trying to maintain about 6 positions. So you take your 115K, divide by 6, and that gives you, I'd have to pull up the calculator to get the exact number. And handy dandy, these calculators. 115 divided by 6, right around 19, 20,000 per position. Some can be bigger, some can be smaller. And I typically keep a little bit of working cash just in case. Right there.
Now, Jim C has a good question. He says, I would appreciate an answer to this one. On bid and ask, what is your strategy for picking a price you're willing to pay or receive? On the bid and the ask anymore, I'll tell you something funny, Jim. When I was selling calls yesterday, which I was doing a ton of it, um, I put in 5 orders, and I put them all in instead of I normally put it in on a limit that's somewhere between the midpoint between the bid and the ask. But all 5 of them I put in to sell the call at the market once I picked the strike, and I got filled better than the bid 4 out of 5 times.
If you're selling credit, that was amazing. Better than the bid. Oh, we lose Jack. Or do we lose me? So we lost Jack.
He's had some internet issues with Starlink the last couple of days, so he might be a little in
All
and
right.
out
I was
today.
wondering if it was me or him. Appreciate it.
No, you're good. You're
Well,
crystal clear, my friend.
all right. Jack will be back in a minute, probably. And so he went right at the bid, he said, trying to sell credit, and got filled better than the bid. Like typically we buy high and sell low, but he was selling high and he actually got filled higher, is what he just said. So starting at the bid is a great place. There you go, Jack. I think you're back.
Yeah, I got this Starlink, and it's just been shaky today.
Yeah, which one you got? You got the newest one, or you got version 2?
I don't know. The boss lady of the ranch, she set it up, and it's been pretty good. But there was a plum tree that was growing in front of the dish on the
Okay. Yeah.
right, and it was working great. But 2 days ago, a bear came in and tore the hell out of that tree, ate every single plum off of it, and he knocked the branch, hit the dish, and it's kind of tilted, so it's been all spotty since then. Then after he destroyed the plum tree, he went and destroyed the apple tree right out in front. I mean, it looks like it was struck by lightning. It just ripped the heck out of it and ate every single apple. So he messed up my dish in the process. So it's a little shaky and spotty for me, but we'll see. Maybe the ranch boss lady will reset it, and I'll be all good to go.
Yeah, so we were just talking. We lost you right before I asked you if you were selling at the bid. I think that's what you said.
I put it in now. I'm putting them in at the market when I sell them, and I've been
All right.
getting fills that have been higher than the bid.
All right. So you went for the market, which is usually like the mid, which is halfway between. It's not always there, but that's usually where the market is. And he actually got filled above. The broker did you a solid and filled you above. And not all brokers will do that.
Well, here's the thing: is I don't know if with a market order, it has to be filled instantly. So I don't know if when that order came down, it just got matched up with another order. and the market maker
Yeah.
didn't even do it, or he did fill me at the ask, and then they raised the price of the option. But that's what I've been doing, Jim. See, I hope that answers your question about that.
And you look at this on IBIT. I mean, these are only penny spreads right here anyway.
Yeah, that's good. That's how you know you got a good liquid option. Look at that volume and the open interest. When you got a real tight spread like that, that's what you want. You see some of these options that might have a 50-cent difference between the bid and the ask. That's the recipe for disaster. And the other thing is too, when we don't really buy options here, but if you did, you would never want to use a stop loss on that. But when you're on the sell side, you're good to go.
And you want to see some crazy options. This one right here.
This stock, first of all, you got to pull up a 5-year chart on this stock. It's insane. I don't know if I've ever seen a stock that would be harder to lose money on than this thing. Or a 10-year. Look at that thing. There's no
That's
other
just the last
stock,
5 years.
there's no other stock like this. Maybe Orly, Orly. I don't know what it is.
Same business, yeah.
Doesn't pay a dividend. And the guy that owns this thing has a little fishing place right next here to this cabin down the road. But that stock, look at that thing. And
That's O'Reilly.
it makes no sense, AutoZone.
And O'Reilly, the same thing right there. Look at that.
I remember when it was $250 a share, AutoZone, and I thought, look at that. It's just like an Orly too. Orly just split. I was in it at 89 on the split, and I sold it. And look, it just keeps going. All right, I didn't mean to hijack the discussion about AutoZone, but that chart on that thing, it just blows my mind. If you got the patience, if it paid a dividend, I'd be on it like stink on a monkey, but I don't want to just buy it.
But this is an example of illiquid options right here, or low
Sure.
liquidity options, when you got a $12 spread almost, or $11 spread.
That's huge.
That's if you accidentally bought one and then you accidentally have to sell one, you just ate $11 loss, $1,100 loss.
So you're better off not messing around with that one.
Yeah, that's dangerous right there.
But what a chart, man. Holy mackerel.
Yeah, absolute, like that's absolute bananas. And it's set to go higher too. Is you can't afford a new car, so what do you got to do? You got to fix your own. And
It's just
even
been,
if you
I've never seen a chart on any company like this. And, it's not real tech. It's just basic stuff. But man, oh man, is that a winner.
And what's funny, if you try to fix your car and you mess it up, like you don't get it fixed, they're going to sell the parts to your buddy that knows how to fix it. Yeah, so they win all the way around. Like, and they even sell to the shop next door to me too. So
yeah, they're just selling parts, but apparently tariffs haven't hurt them. That's another crazy thing about this. They're selling parts that aren't made in the United States, and it hasn't affected the stock.
yeah, and they apparently they've been able to roll those tariff costs right into their parts.
Yeah,
and nobody cares, not even blinking. So
not even. What are you going to do if you got to buy? You got to buy it. You got to buy it, right? You don't really have a choice. If you got something's broken, you got to have it fixed.
Yeah,
I mean, fixed the tailgate latch on my old Tundra, and busted out a rear tail light, and had to order that part and get that fixed.
it's kind of like what's your options? You have AZO
And Orly
and O'Reilly's, and then you've got a couple other ones like Napa and Advanced Auto. Advanced Auto looks horrible on their stock. Actually, I don't know how they're been so horrible compared to these other ones. But you got those, or you got the dealers, and the dealer parts way more expensive, just ridiculous compared to these. So where are you going to go? You're going to go here. Where's the shop? Where's the independent repair shop's going to go? They're going to go to these guys. One of these guys right here. And it's just like almost a captive audience business when we have millions of cars on the road. The
car hasn't changed. I in Florida, I have even the Tundra. My buddy's got a new Tundra compared to my old 2008. But The engine, the brakes, the tranny, it stays the same. What doesn't stay the same is all the bells and whistles they add to it, you know.
Yeah.
And
See,
some
obviously,
gotta get it.
obviously these guys made a mistake somewhere. They went off the path.
Yeah. Well,
So not all auto parts are created equal.
but if you look at AutoZone, that's a long trend, right? That's a long proven track record of executing their business plan really well. A fascinating
Yeah.
trend.
This is a jockey that's good at what he does
Yes,
right
sir.
there.
Made a lot of money. Yeah,
And this one is too right here. Obviously, these two jockeys know what they're doing.
yeah,
AAP, not so much.
yeah. The only thing would be better is if it had a dividend. You know, in AutoZone, you can't play. Was that over $4,000 a share now? And they don't believe in splits, that guy. So I don't know if this thing's going to ever split, but at 4 grand, uh, that's, I don't want to play with that.
Yeah, it makes it tough
It does.
for smaller players to get involved.
Yeah. I don't know why they don't want to split it, but the guy doesn't, you know, the board, they don't care about that.
And they've only got 16 million shares. So they're providing huge value to their 16 million
They sure.
shareholders.
Yeah.
You know, and only 70 billion dollars. That could easily double again too.
See, we were talking about that with NVIDIA, why that's so hard to double and why a stock with a lower float and a lower market cap has way more upside, right?
Yeah, people look at this and they're like, $4,000. That's like, that seems like it'd be really difficult to double. But in reality, that only represents $70 billion. So
It's not
all it would take is $70 billion flowing into AutoZone.
to go to
And
8,000
then, and then you have something that's worth, you know, $8,400 a share
Yeah.
right there. Now we look at something like NVIDIA, and this thing has 24.4 billion shares right here.
Which
So
is
$1 move on NVIDIA is $24.4 billion into or out.
isn't that crazy? Harder for this one to double.
So even though this thing moves around more, it seems like on a relative basis, that's a lot more money. You know, look at this thing moves $3. That's the value of AutoZone.
Yeah. Yeah.
Is
It's
it?
20 McDonald's, right? So somebody had a chart out on it yesterday, how much it's worth compared to like how many multiples of McDonald's. You need 20 McDonald's, right? Whatever.
Yeah, McDonald's 25, you know, $225 billion right there. So like a $10 move in NVIDIA is an entire McDonald's.
Corporation. Yeah, that's crazy.
So, you know, McDonald's has 713 million shares, you know, almost 714. So this number, a lot of people don't look at it, but this number is very important
Yes.
when you're looking at, you know, the volatility of a stock right here and how much money is actually flowing into and out of the market. I look at these, you know, when you're messing with, I keep this chart up too. Close this ad. I keep this chart up right here just to remind me, these big dogs right here, these top 4 or 5 up here, very difficult for them to double in share price.
Or move at
It's
all.
just,
And
it's just the law of big numbers. Law of big numbers.
when I saw GOOG this morning, you know, to move that company, a $2.7 trillion company, to move that 8%, that's crazy. And I think GOOG is up about 8% this morning. How do you move a $2.7 trillion company 8%? That's crazy. That's a crazy move. I'm long Google, I'm long McDonald's, just in full disclosure.
I'm long McDonald's also. That's, you know, every dollar is almost $6 billion right there, $5.8 billion for every dollar they move. So this $20 move today, it's like, that's a lot of money.
Yeah. I sold 250 calls this morning.
Nice.
I'll get
250.
called out.
Woo.
Think I'll get called out on the 250s for October 17th.
October 17th. Let me go look.
Let's look at a chart and then let's do a little just on the regular GOOG, not the GOOG-L. And then
Well, I mean,
we'll ask the good folks at home. The stock is at 229. I sold the 250 that expires October 17th. Do you think I'll get called out or not? Yes or no? Type it in. What do you think, Jeffrey? You think I'm going to get called out? Steve says no. Steve was in there with me. Jim C says no. I think he was in there with me too. I'm not going to get called out. Now,
I mean, look at this. Look at this trend, though. I mean,
I think this
we've
gap
been,
is going to fade a little bit, though. You
it
know,
might, but we are hitting a target, one of my technical targets right there, and very commonly, that's 70% likely to get hit when we do a pullback and we expand. But this has that other pattern we've been talking about, Jack. That 52-week high
yeah,
after consolidating for a few months
yeah,
for the next 6 to 12 months. Google is set statistically to outperform the S&P 500.
Now, this stock was so overlooked, though, the last month or so. Like, people just weren't digging it.
It's very possible. I mean, this is a strong move, and it's getting stronger, not weaker.
It is getting stronger. I thought it'd pull back a little bit this morning already and not be up 8.6, 8.7%, up 18.5 bucks. That's wild. That's a big, big, big move. Now, if I was just trading this stock, anytime you get an abnormal move up, like a gap up, that's your sell signal right there. Because this thing doesn't normally go up $18 a day. So you got a built-in sell signal anytime you get a gap up, and I would expect this to not hold up in the next couple of days. Like Microsoft had that big jump, and then it faded, right? I think that's going to be the same thing.
But you know what's interesting here? Microsoft actually hit this fib level right here, which is only 35% statistically likely to be hit on this pullback and continuation move. I've got hundreds of thousands of trades kind of proving this, but this one's 35% likely. This level was 70% likely to get hit right here. And this purple level right here was 75% likely. This is my signature technical pattern. I spent years trying to put numbers to it and prove it. Last week while you weren't here, Jack, I showed people how to build their own indicator and start putting statistics to these high probability patterns themselves. So if anybody missed that, you can go watch the replays of last week.
I can't wait to watch that. I found out that I missed that. That was such a great idea to do that. Yes, Dennis, I did say that I have sold the 250 call. I didn't buy the 250 call. I'm long Google, so I sell covered calls against Google every month.
Yeah, I was concerned with this pattern that we might get a pullback in here, so I kind of laid off of it. I was selling puts like crazy till we got right up at this 180 level. I sold them from down here right up into here, and I just laid off of it. But maybe I should have been more aggressive and gotten put, because that looks like a rocket ship now.
Sure does. I could use getting called out at 250 because I need to get called out 3 or 4 times a year and take a really big profit. My cost basis on Google is below 150, right? So if I get called out at 250, I'm good to go.
That's a big profit right there, $100 a share.
Yeah, let's put the replay link, Jared, if you have that. I want to see the replay myself, but Dennis is asking for a replay link. Yeah, this is great stuff.
Yeah, if Jared doesn't have it, I can grab it really quickly too out of my Discord.
Yeah. Yeah, I love watching the replay. I watched the replays that we did already. Just it's good stuff, and I just want to make sure that I'm on top of all of it, because you never know where conversations are going to go.
And we, like I told you, Jack, we're gonna have some conversations. I'm gonna bring some stuff to the table I figured out. You're gonna teach me some stuff from the market maker side, and we're gonna, come together. There's the replay link right there for everybody. Market Master replays.
Speaking of market makers, yeah, there's the replay link, everybody. So last week, when NVIDIA was about to announce, I did look at the computer. I was trying to take the week away from the stock market. But I noticed the NVIDIA options where we were talking about how do you determine the expected move, right?
Right.
Yeah, at the money put, at the money call. And it ended up being about an $8 swing either way. And nothing happened. That was the weirdest part. I mean, later, a few days later, it happened, but right on the earnings break, nothing happened. And so they had the options priced out with an 8% move, and the stock would have to move more than 8% to make any money on that call or that put that you bought. So anybody that bought calls or puts got killed.
Yeah. It's kind of crazy. I mean, you can sit, for anybody that missed this conversation, what you do, you come in here at the money, roughly we're closest to 170. So you take and you'd sell the 170, you just take the ask, you'd sell the at the money call, come over here to the put side, sell the at the money. You don't skip strikes or go anywhere. Same strike, both sides. Sell this one at the ask, add those two numbers together. So $4.50. So that's the expected move on NVIDIA right now with no earnings, no nothing, $4.50 between now and expiration on September 5th. Now you might ask yourself, all right, does this work for every expiration? The answer is yes. December 17th, all the way out here in 2027, 835 days in the future, same deal. Grab the at the money, 170, 47.50 here, 47.70, 32.95 over here. Add those together. That's your expected move. Basically pricing in $80 move between now and expiration day, 835 days from now.
That is slick, Dennis says. Yeah, that's how you know the expected move. Now that doesn't mean it's going to happen. That means that they've priced it like that, right? So if it doesn't make a big move, that option isn't going to move. That's time decay is going to eat that thing up. So
and that's both sides. So that's $80 up and $80 down that they're pricing in.
Now they're pricing that in because they themselves need to cover their ass. They're not saying that we really expect it to do that. What they're saying is, if it does that, I need to be hedged, right? So I'm going to charge the buyer of either of those options an outrageous price to protect myself as an options market maker. That's really what that is. They expect that move to happen, and within that range, they won't get killed. They'll make sure because they'll jack up the price of that option. That's why I say now is the single best time I've ever seen to be an option seller. I've never seen, we look at stocks that aren't even tech, the Gap, Urban Outfitters, Dollar Tree, right? All across the board, folks, you want to be an option seller. That's where the money resides.
And this, I've just been printing money. For anybody that's missed the Gap, look, I collected money right here, $168, right here, $270, right here, $253, and I never bought the stock.
I love it. It's a different way to trade where you're not buying stocks, you're just bringing in cash. That's income trading at its finest.
Right there. And I haven't been put stock, I haven't collected. It's, just do these over and over and over right there.
Yeah,
so
these principles work. And that's, yeah, they do. No, I love what you're doing here. I love how you've seen the whole market from the 90s and all that, and you're right here at this spot where you're basically an income trader.
Yeah, I do other stuff. Yeah. Speaking of income trade, Jack, I want to tease this off. I just got this put together. We're not selling this today or anything like this. This is what Jack and I are we're gonna test it out for the next month or so, and then we might sell it here in October. If I think October 12th is when the team's thinking about it. I want to show you this, Jack, that I built. Just tease everybody.
Can't wait.
Look at this thing right here. This is an automated system. I had nothing to do with this. Here's the entry right here. It said sell a SPY. Yeah, this was yesterday. Sell a SPY put for today. Buy one for today. Get a net credit of 41 cents. Your close target 50 cents, 50% of the credit. 20 cents right there. So your risk, 59 cents per contract. That's a potential return on risk of 34%. And if you want $1,000 risk, 16 contracts right there.
Man. So
Now,
this thing finds the trades by
it
itself?
finds the trade. And I did the, yeah, it finds it by itself. And I actually took this trade right here. I got a little bit worse fill, did 16 contracts. And at 4:09 p.m. after the market closed, I got out for the profit. Half of the credit right there
In one day?
in one day. So it
Dang.
was a day trade. Usually they're not day trades, but this was a day trade. And I had a few members hold it overnight and they did even better, got better than 50% of the credit because SPY went up overnight. So right there. I just want to tease that out, Jack. We're going to be testing it out, showing it off for the next month or so.
Because if you have that tool, you don't have to go through the brain damage of picking the strikes and the expiration, right? You just let
right.
I got a similar thing in the cash flow agent where it's picking credit spreads for me. And the thing scares me. It's kind of like they took my strategy out of my head and programmed it. And it's kind of like Jack in the Box for credit spreads, right? It's just crazy.
Yeah, this thing works on the three main indexes, SPY, QQQ, and IWM. Works on those ETFs, finds high probability price patterns on a certain time frame. And when it finds the price pattern that I like, it goes and picks out a credit spread. And it actually loads up a brokerage account and goes and pulls a real live order and throws that into the alert. So it's not like it's not lagging prices or anything like that. It's a real live market order and it grabs it and throws it into the alert just like that. It took me a little bit of coding to get that worked up. I did that all myself. I didn't rely on any AI or anything like that. So
Yeah. You know how to do the coding and the programming?
I do.
Dangerous now. Man. I can't even
that,
program that coffee maker. So I'm way behind you on that.
that's why last week I showed people how to code their own indicators and their own strategies in TradingView so that you can test out some ideas and put statistics to it. So, without further ado, I think we should probably just talk about the fact I have a day trade system that runs on a 1 minute time frame
Yeah.
that automatically finds these trades and picks them out. And when it finds one, there's one that stopped out, but here's one that worked right in front of it. Let's pull it up here a little closer. Right there, it worked out. And it throws out alerts just the same.
Wow.
Grabs it. There's my technical pattern right there.
Already built and done for you.
And this has been out for a little over a year. The win rate on it running about 70% on real live trades. I was trying to find, I think I have the win rate up here if I can find it. Yeah, I can just pull up a new window. Give me 1 second. And oh, I typed it wrong. There we go. Pull this over, show it off here. These are all the recent live trades back to middle of August. Since this went out a year ago or 13 months ago, the win rate has been 73.62% since July 10th, 2024. Just in the past 7 days, we have 50. Yeah, 2,450 wins.
So
right
that's
there.
that's a proven system. You've got enough data in there to bank on that win rate.
It's just the past week, we've had 56 trades and 40 of them are wins. 3 are still open, 13 losses, 75% win rate just the past week.
Explain this to the good folks at home, how this works.
Yeah, so this system sits here and runs on actually 11 tickers. And that's SPY, QQQ, IWM, Apple, Amazon, Meta, Microsoft, NVIDIA, Netflix, Google, and Tesla. I threw in Netflix just for a bonus because it used to be a FANG stock and now it's just everybody wants to forget about it being a Mag 7. So I throw in the Mag 7 plus Netflix. And this thing just sits there, this algorithm I built, and watches every 1 minute candle and looks for my signature technical pattern. When it finds the technical pattern with the entry signal, that we talked about, it fires off the alert. All the green checks are wins. The red X's were losses. Any of them that aren't crossed out, like these ones up here with a question mark, still open, still waiting for the result. Right
It
there.
sends the alert to the subscriber by
Yeah, it
email.
actually, well, it doesn't do it by email. It sends it out via Telegram or Discord, either one. These are so fast. These are day trades, absolutely day trades. They're not, yeah, I don't want to pretend like these aren't day trades. These are very fast trades, usually less than an hour. And here's
Wow.
here's the channel where these alerts come in. We'll see, mark this red. Oop, wrong button. Missed the market red. It fires off alerts just like this. Tells you, it actually picks an option for you. Doesn't pick a spread, but it picks an option suggested. And then when it hits the target, gives you the exit alert right there.